Great. Well, thank you, Lisa. Appreciate you having us. I'm Matt Hamilton, and this is Patrick Long. Uh, I'm the founder of a firm called Hamilton Capital, which is located in Columbus, Ohio. It's a large by financial advisory standards. We manage about $4.4 billion. A lot of that is dental capital, and we do both wealth management and investment management for dentists and for other private clients and institutions. But as I said, a lot of it is with dentists. We have many clients throughout the country that are dental professionals. So tonight we wanted to talk really about investment philosophies, which is really a key part of gaining financial independence. But I'm going to start by just kind of going back and saying, well, what are we going to do? What are we going to do tonight? What are we going to talk about tonight? And then I'm going to start to just dive into the program, and it'll be a little bit of review from the last session that you had if you were in attendance, and then we'll move on to some of the more the investment topics. So the first thing we're going to do is we're just going to talk a little bit about what financial plan and independence means. What is it? How do you view it? We're going to talk about one of the keys to get to financial independence, which is compounding. We're going to talk about what drives investment performance. We're going to look at different asset allocation strategies that do that and their effectiveness. We'll talk a little bit about portfolio construction, alternative investments, overview of the investment process, and then we're going to give you a big, high level overview of the current financial markets and their conditions. And at the end, we'll take questions and be glad to talk over anything that you would like. So with that, let me just kind of get started. So financial independence, what are we trying? What does that mean? And what it really means to us and what it means to our clients is having enough financial resources to maintain your lifestyle after inflation. And you want to be able to do that through retirement without spending principal. If you look at that little blue graph that's in the middle there, you can see if the left side was where you started retirement, the right side is where you exited retirement, and the goal is for that to be an ever-growing thing, so that effectively you could live forever and you could not outlive your assets. And one of the big questions we get with clients, especially after they've sold their practices and they've gone into retirement, is, do I have enough? And I'll talk about that in a minute. But then the second part of that is, am I going to run out of money? And our goal is of course not to have that happen, and that's going to be really, really key. So the question really starts with kind of, what's the number? How much do I need? What is it that I really need to have happen? And so I've got on the left-hand side of the screen here kind of an example of what that might look like. So you look at it and you say, well, look, I spend, outside of taxes, I spend about $200,000 a year to basically maintain my lifestyle. To do that, the key question is, well, what kind of investment return can I consume during that time? And then how much money does it take? So generally with portfolios, a kind of a common rule is, if you take a 4% of the value of your portfolio out every year, then generally you will accomplish a return that you generally accomplish a situation where you basically start retirement with less money than you leave retirement, and it kind of grows throughout retirement. Now, to do that, you've got to make a return that not only exceeds 4%, but you also have to make a return that offsets inflation. So if inflation's 2%, then I need to make like 6. But doing the math real quick, if I look at what I take out for a portfolio that I need 200,000 living expenses and a total of 275,000 coming out with income, I need about $7 million, just shy of $7 million for that to happen. Then on the right hand, what we show here is okay, in a year, let's say the first year, I start with 6.875 million, and then let's say I make 6% on my money. Well, so I would have made $412,500. I take out an allowance for taxes, I take out my spending, and when I'm left, I have 137,500, which effectively just brings the value of the portfolio up. And the goal is to have that continue to do that for basically the remainder of your life and throughout retirement. So, to do that, one of the key issues is, well, how do we get that done? And probably the most important concept that I can give you is one that you already know. You've known this from, you learned this when you were very young, and it's the power of compounding. It's the ability of returns to build on returns. Albert Einstein, said, with compound interest, it's the eighth wonder of the world. He who understands it earns it. He who doesn't understand it pays it. But the key is this: we need that compounding to occur. Now, think about that at a different standpoint. When you go to your financial advisor and you start talking about, well, what are my objectives? This is probably the number one objective that I have. I need my return to build on returns, to build on returns, to build on returns over a lifetime. This is not a, oh, I happened to work for 2 or 3 times. I need that to occur. So when you're speaking to your financial advisor and you're saying, I want to, what they ask you, what are your objectives? The number one objective is this: it's building returns on returns on returns. Because, and I'll give you, and it kind of looks, hold on here, there we go. It kind of looks like this. So this is fairly simple. You sit there and you can see over a period of time of 25 years where your portfolio, the goal is for that portfolio to grow at a rate. And the more that you grow that portfolio, the higher that rate, the greater your portfolio will be. Now, what I want to show here, though, is this. If you started and you made the first year, you made you had $1 million and you made 5% in your first year or 7% in your first year, you're going to make $70,000. The goal, though, is to let that 70 then grow, and the next 70 and the next 70 and the next 70. So if you get out to, say, year 20, and I've now got $4 million or $5 million, we'll say it's 4, and I still make 7%, then all of a sudden that instead of making $70,000 a year, I'm making $280,000 a year. And the goal is that over time, I need this to build. And to do that, there's some things that have to absolutely happen. And before I go there, I want to understand that the first thing everybody's going to say is, well, we need a good return. And of course you do. And then you need a good absolute return, but you're doing something more than that. This is what we're trying to get, is what's called a compound annual growth rate, not an average growth rate. And what I show on the screen here are 2 portfolios. The one on the right is a portfolio that averaged 8%. In fact, both portfolios average 8% over a 10-year period of time. But if you look at the difference, one ends up with $2.1 million and the other ends up with $1.95 million. And so there's 150,000 or so difference between those 2 portfolios, averaging 8%. And the key is it's a different compound annual growth rate, because the one on the left compounds more because the returns were building on returns. And to do that, there's a couple things that, and what you want to do is you want to string those returns together over time. And so here's a good example on the right side there. We just take one of our portfolios, and I'm just taking a period of time from 2021 to 2023. And if you look on the left-hand side, the dark blue column is the portfolio. The right column, the gray column is kind of like what the markets did. And if you look at it and you see in the first side, well, they both made 14% in a year. But if the next year, and one lost only 2 and the other lost more like 15, then what happened mathematically, we're building from a higher level. And so even though, to kind of give you an idea, even if you look to the next year and one makes 8 and one makes, almost 16, believe it or not, if you just stopped and you snapped right there, and let's say you just took from 2021 to 22 to 2023, at the end of that time frame, if you just took those 2 years, the market would be even, but you would be up, even though you made less in the second year, because you lost far less and you were compounding off of a higher number. So this idea of compounding is really important. and controlling volatility and controlling down markets is very, very important. And you can see the result on the right-hand side. On the right-hand side at the end, you'll see that one portfolio, the portfolio made 21%. The markets themselves made it significantly less money. And this is what you want to do, but it's not just for 3 years. It's for the entirety of your life. This is, investing is a long-term game. You hear it as a long-term game, but you have to execute as if it's a long-term game and not necessarily just chase returns. So what are the 3 key elements to compounding? And this is something, and the first one is I need to make a high quality absolute return. Now, what's an absolute return? An absolute return is the actual percentage that you make on your investments. If you do a projection that says over time, I need to make a compounded annual growth rate of 7% on my money in order for me to get where I need to go, then what that means is in order for any projection that you do to come true, you have to make 7%. How that relates to financial markets isn't as important as it is to, can I get that return? And the other thing to keep in mind is only positive returns compound. If I get into a portfolio that has a lot of volatility and one day it's down a lot and then all I'm doing is recovering back to even, I haven't compounded. And so, this idea of compounding, this idea of stringing together high quality absolute returns is probably one of the key objectives. So when you're thinking about, what are my objectives? One of those for my portfolio, one of those for my lifetime is to build high quality absolute returns that continually compound. Second part of that is more consistent returns, which I just kind of demonstrated before, tend to compound more because they just geometrically multiply. They become exponentially greater over time. So, the way to harness that is low volatility. So, you'll hear people say, well, I think I can take a lot of volatility. The key question I would ask back is, as you're looking at that, is to say, what does that do to my ability for returns, to earn returns, to earn returns? And so consistency is really an important thing. That doesn't mean there's not going to be down markets. Doesn't mean there's not going to be negative returns. But what we want to do is we want to harness those as much as we possibly can, and minimize those as much as possible. Because steep losses can set you back years and years and years. And I want to stop here maybe and say this to us. If you think about what's happening, and happens, we all have a limited period of time, even if we're young. There's a limited period of time that we have to invest the money. You think, well, I'm 40 years old, and I'm going to retire at 65. I've got 25 years. Then that's right. You've got 25 years to accumulate what you need for financial independence. But then you're going to have to spend it for maybe another 25 years. But the older you get, the less time you have, obviously. But what if you have a major down market? It may cause, and you're caught in. You may be in a position where you don't get where you want to go. And I'm gonna take you forward a slide here to kind of show you that. Yeah, there we go. So before I go back to the other, I want to emphasize this slide. So this is looking at 2 levels of loss. So if you think about what am I trying to do, we talked about going along this path where you're trying to continuously grow the size your capital over time. So this illustrates basically 2 portfolios. One, you got $1 million to start. You're going to end up at 2.8. That's a 7% compound annual growth rate. And along the way, and we'll just do it at the very beginning to start with, I lose 40% of my money. And people say, well, okay, now I've got to make 66% to get back to even. But that's not what you're really trying to do. Because my real goal was, if you look at this graph, was in 5 years, was not to have and just get back to $1 million. At the end of 5 years, I wanted to be at 1.4 million. And then I wanted that to compound to become over 2 million. And then that to compound again to be over 2.8 million. And so getting back to even and getting back on track, getting back to that 1.4. If I lose 40% in the first year, it's not a 66% return I need over the next 5 years. It's 18 and a half. It's almost 19% a year consistently for a 5-year period of time. And that is a very, very tall order. And if you think about it, and as you do that, you have less and less time to make that up. The second part of this is that if you can limit that decline, which is on the right-hand side, I just have to show 15%, then what happens is that you just get back faster. It just becomes more manageable, and you're back to having returns, really build on returns. So one of the things we look at is to say, well, how do we do that? And one of the things that we look at is I want to really emphasize is that absolute returns and market returns could be completely different. The market return is what the market's return. It could be, it could be the S&P 500. It could be a 60-40 portfolio. Both are illustrated here. I'm going to kind of point you to the right-hand graph. This is the S&P 500 net of inflation for basically over the history of the index. Goes back to the 1920s. And one of the things that you hear is people saying, well, we're just going to ride with the markets. We'll ride with the S&P and it'll all work out. And they usually point to the right-hand side of and say, see, it just goes up. But what I want to show you is historically, it doesn't always do that. And that historically, there's different periods there. Most recently, really from about 2000 to 2013, where the market net of inflation made no return. Now put that into compounding. If I take a return and my return goal was 7%, okay, every 10 years I would have doubled my money. So effectively in 13 years, if I started with $1 million, I would be looking at trying to have something that spends more like about $2.3 million. But I got $1 million. And then that just sets me back to the next from there. And I've got to keep on doing better and better and better to compound. So the point I'm making here is, you've got to be very aware. We've got to be very aware of the environment we're investing in. When people identify and say, well, all you got to do is ride this market and it'll just go with that. The issue is if the next 15 to 20 years, 30 years look like the last 15 years, great. But if it looks like the time before that, it could be a real challenge. So what advisors will often do is they'll say, well, let's ride with more markets. Let's just put a couple more in for diversification purposes. And so on the left-hand side, I show a 60-40 portfolio. It's a portfolio of 60% U.S. stocks and 40% U.S. bonds, as represented by the S&P 500 and the Bloomberg Aggregate Index. And what I wanted to show you there is you can see all those periods. I don't know if the gray bars show up very well in this, but where you see them in red of all the times that a portfolio made no return after inflation. And so what we're looking for is to continuously make high quality returns in all environments. And that doesn't mean some won't be down, but you want those downs to be limited, and you want to move forward. So with that, I'm going to take just a second, and I'm going to talk a little bit about driving performance and talk about asset allocation. And then I'm going to turn it over to Patrick here, who's going to talk a little bit about portfolio construction and talk about what we look at, what needs to be looked at from the standpoint of driving returns. So let's talk about what drives performance at the end of the day. And the first thing is, and you've heard this probably from every financial advisor that you've ever spoken to, if you have, is asset allocation drives performance. So you can take investments and you can classify them into classes. And so, for example, you can have U.S. large cap stocks would be represented by something like the S&P 500, or it could be small cap stocks that is represented by the Russell 2000. And you can divide both, in the U.S. and internationally. And what you end up with is you can say, well, here's just a on the left-hand side, just an idea of what of all the asset classes that you could look at. And I want you to walk away with a couple things about this. Number one, asset allocation is the predominant driver of return. There's been a lot of academic studies on it, and it's how we arrange your portfolio among these asset classes that is going to be the determinant of your return. And in looking at that, I want you to keep in mind, I didn't say it was a good return. I just told you what would be the primary driver, what the decision would be, because every one of these asset classes has two features that you need to keep in mind. Number one is every one of them has a future return. And there's a reason why in a lot of the prospectuses it'll say past performance is not an indicator of future results. But every one of these has a future return. And that future return changes from time to time. So what it is in this year and what it is in next year and what it is in the following year could all be completely different. The second thing is that they change as the economies change and as market conditions change. So what's particularly good for an asset class today may be particularly bad for it tomorrow. And so it's quick. You need to keep in mind that the process of choosing this mix of assets is what asset allocation is about, and it is going to be the predominant return determinant of your future performance. A lot of people will talk about, yeah, but then they'll get into how we might pick stocks, or we might pick bonds or whatever. Important, but this is probably about 10% of the return, depending on the study you look at. Most of it comes back to getting into the right asset classes. And you can get, in a diversified portfolio, you can have the best portfolio in a bad asset class and get it outperformed by the worst portfolio in a good asset class. So really getting your asset allocation down is really a very important thing. And if you think about it, it's a forward-looking thing. We're trying to figure out where to align the portfolio going forward in order for us to in order for us to succeed, in order for us to get the absolute return that we need, in order for us to avoid volatility, et cetera. So two strategies, and then to do that. This one is one that I think you would start. This is traditional asset allocation. This is something, and I just want to kind of help you understand what a lot of financial advisors do, and this is many financial advisors seem to do it this way. We did a little bit of different in Hamilton Capital, and I'll talk about that in a minute because it's another way. But I want to talk about this and what this is. What most people will say, a lot of advisors will say, is they'll say, "Look, it's very hard for us to figure out exactly what the future returns of asset classes will be, but we'll look backwards." And we're gonna theorize that every investment condition that we're going to see into the future has been seen in the past. And they're going to look back over 120, 130 years potentially. Some do it for less time, but they're going to do it for a long period of time. And they're going to come up with things like, well, here's what the average return for different asset classes were. Here's what its volatility was. Here's how that return relates to another asset class's return. They call that correlation. And we're going to kind of look at it and say, if we put these all together, what would be the optimum portfolio to get the return that I'm trying to get with the volatility that I'm trying to get? And the weakness of there's a couple weaknesses. And the biggest weakness is we've looked backwards in order to look forwards. And oftentimes what happens when advisors do this, they're looking back 120 years. Well, if you take that 120 years and you'd start to divide it into 10-year blocks or 15-year blocks or 20, shorter time frame, more in line with what it is that you're going to invest, you're going to find all of a sudden that for one 10-year period, it looks completely different than the next 10-year period, which looks completely different from the next 10-year period. And we saw that in the S&P 500. And so what happens is if you sit there and you say, well, here's the correlate, for that correlation, for all that to come exactly true, then really everything has to be repeated within your investment time horizon in the exact proportion with all the exact catalysts, et cetera. And it's kind of, and we think, there's a good chance that could fail. Okay. The other thing that they'll do is they'll say, well, some will just say, and I've had it as the neutral allocation, we're going to always maintain this allocation in all investment environments. And we're just going to ride through and and it's all going to work out in the end. And they say, all you got to do oftentimes is hold it for the long term and it will all work out. Okay. But they don't tell you what the long term is. And if you go 15 years and you haven't hit your return, then what happens? You just haven't held it long enough. Now you may run out of time, but you might, you didn't hold it long. So one of the things they'll do is advisors will also then create a maximum and a minimum allocation. They'll say, well, it's normally this, but we're going to kind of give it a range. We're going to do a little bit of our own adjusting along the way. How they do that is another question, but that's one of the things they do. And you'll see a maximum allocation and a minimum allocation. And this is not uncommon, and they're not usually all that far off of what the neutral allocation or what the normal allocation they're expecting would be. But let me kind of give you the downside of that. So let's assume we get into a market and that's it's really tough for large cap stocks. And let's say that they end up giving us a return of a very low return, maybe zero, for a 10-year period of time or a long period of time. Under this asset allocation, these asset allocation rules, you've got a mandatory 40% return in an asset that potentially doesn't return any money. On the same time, if it's one of the best assets by far, I mean, it is just so attractive, they limit the upside of it. So in this particular example, it looks like it would be 50%. And it may be that it's so compelling you'd really like to have 80, but you're outside of your limits. And so this is something to be very clear on with your advisor. What are my limitations? How is this going to happen? How dynamic is this process? How are you going to look forward? How are you going to figure out whether I should be in large caps or mid caps or small caps, et cetera? And so that's one way of doing it. Let me give you the other way. You're more dynamic. You're looking at it and you're saying, I'm going to look over the horizon. I'm going to use the right-hand column again to kind of give me an idea of that gives me the historical context. But notice that on the maximums are very high and the minimums are all zero. Okay. Meaning if that asset class isn't productive, I don't want to be there. Now it takes a very forward-looking firm that can do it. It's one that is steeped in research and has a good track record of being able to do this. But this is a more dynamic process. Now, what this promotes by doing this is three things: the absolute return, because I'm only going to places that generally I want to make money. I can make money. Number two, places where that have lower volatility, and I'm going to try to avoid the assets that are very, very dangerous. And from that standpoint. So we're going to talk about portfolio construction, and I'm going to turn that over to you.
All right.
Yeah.
So portfolio construction, I think this is, as Matt was talking about, I think this is one of the more unique pieces to how we think about this, and maybe a little bit different than how maybe you've seen it before. So as Matt was saying, we use a very dynamic approach to this. And when I think about dynamic, Matt just talked about different ways that we think about that. And, the word that comes in my head is always flexibility. Having the flexibility to move around to different asset classes, maybe own one asset class, maybe not own another asset class. And what we're really looking for, what we're looking in this dynamic process is compelling returns and a high margin of safety. Because if you think about how Matt talked about this on the cornerstones and of how we think about building capital and meeting financial goals, it's about that consistent return. And it's also about avoiding those large losses. And if we're doing that with a compelling return, that means we're getting that consistency of return. And we're doing that with a high margin of safety. That means we're trying to avoid those large losses. So it's about that flexibility to also be able to diversify out of assets that maybe have unwanted risks or maybe that have more of a negative outlook. And as Matt was saying, there's a lot of work with this, and there's a lot of research that goes into this as well. So the way you should be hearing about the portfolio design, I think it's really mirroring two different concepts. It's marrying this idea of a top-down approach and also a bottoms-up approach. So a top-down approach is the idea that you're going to scan the entire investment landscape and you're going to say, these are the areas and different asset classes that maybe look a little bit interesting from a top-down view over this entire investment landscape. Then you're going to take a bottoms-up approach and go into those asset classes that maybe you've identified through that top-down approach and say, this is where the real research comes in. We're going to look at the underlying companies and do that research.
Let me add one thing here. So what's on your screen right now is what we'll call the forces that drive asset returns. Now you notice what those are is you see things like these are if asset allocation, the best way to describe it is if asset allocation drives return, then what drives the return of every asset class? And that is these things. So when you take a minute and just talk, if you will, about some of these are the macroeconomic factors that drive those things.
Yeah, absolutely. So these are, as Matt was saying, are top-down factors that we're looking at, and really this is supposed to be an overarching view over this entire investment landscape. We broke this down into three groups: policy, talk about the economy, and then talk about valuation and markets. And really, we're trying to identify different areas of the market that maybe you see opportunity as far as an individual asset class is concerned, and finding which of those different areas that maybe we should spend a little bit more time when we start to go into all this depth with the individual research in the bottoms-up process.
Mm-hmm. Mm-hmm. And what I would say is, with anybody, that is trying to pick out asset allocation, these are the factors that will drive these returns into the future. And it's not, and they all come together in every market different. But if somebody's going to look at it from a top-down view and try to be selective, they have to have a tremendous command of what's going on in each of these areas. We'll
Absolutely.
talk a little bit about that in a minute. Why don't you take a minute and talk about the bottoms up for a little bit?
Yeah. So this is where you should be seeing a lot of research and a lot of time being spent. So we've gone from this top-down process to identify different asset classes that maybe we find a little bit more attractive during these certain time periods. So now we're moving into, okay, now that we've identified this, let's actually go into these asset classes and find the assets. And the way we think about this is really buying cash flows. So each asset, no matter what you're buying, whether it's a business, real estate, whether it's a bond, you're buying future cash flows of some type of the asset.
Yeah.
And really, what you're hoping to see is that those cash flows build up, and that should give you some kind of idea of where those cash flows will be in 2, 3, 4, 5 years. And that also gives you some kind of idea about what you can sell that asset for. And then if you're able to determine both those sides, it gives some type of implied return on that asset that you're owning. Mm-hmm. So this is this idea that you spend the time to look over the entire landscape of the investments and then identify different areas that maybe you find that may be a little bit more interesting, and then going up and actually doing that research to go into those asset classes to identify the assets that are going to be the best ones there.
Yeah, and let me add, can I add that
please.
A little bit? Yep. So what you're doing, you're buying these future cash flows, and right now today, you can go into any asset and the price in the market today. You know that, and what you're trying to do, and what all the research is about, is trying to figure out what those future cash flows are. You know what you're going to pay for them, and then if you sell those at a reasonable price, what might my return be? And then you look at, in this particular example, we show a 10.4% a year return. And you say, well, that's more attractive than this. It's less attractive than that. It's more risky. It's less risky, et cetera. If the price went up for those same cash flows, the return would go down. And so when you're looking at it, and it may go down to the point where you're saying that's not attractive, so I don't want to be in that asset class.
Absolutely. Yep.
And so that's kind of what we look at from the bottoms up. So when it's not about what, when somebody says, well, what's a good investment? The idea is people should be doing all this research to figure out what should be in the portfolio and what shouldn't be in the portfolio. And I think the second part of that is it's going to stay like that until these returns become no longer attractive looking forward. So at some point in time, because things progress along and maybe price went up a little bit, all of a sudden we look and the future return is only 2%. Well, it's probably a time to think about finding another asset. And so this is what part of that dynamic process.
I'll add one more piece to this. And I think this is something that I know that is just so important, is this idea that there has to be some type of process. And we've gone through the beginning process of, and I think this is so key to everything, is that there has to be a big picture goal, is that when you're thinking about this from a financial planning perspective, you can really easily understanding how looking at this from a top-down perspective and then a bottoms-up perspective to get some type of consistent return, some absolute return, how this all builds on one another. And it's just so vital to have that process in place.
Yes. Yeah. And so one of the things that most investors they battle is a couple things. Number one is battling their emotions. The emotions that we most battle are fear and greed. Right now, there's a lot of people that are fearful of missing out on certain returns, and they also are greedy about that too. And they may be taking a lot of risks that they don't intend to take. And what happens is investors tend to be kind of a recency, the recency of what's happened yesterday and think it always continues. So part of it is to be able to know what you're looking for. In other words, to go back and to say, if my big objectives are I need an absolute return, I need low volatility, and I need to avoid down markets, those are real investment objectives. And then you have to have the discipline to pursue that through all market environments, even ones where it feels like, gosh, I should abandon this. And because they generally, if you have a sound process and it's well disciplined, and this would be one of the things I would say is, that your advisor does, then you should be successful. Let me add another thing, and one other thing here. This is something we're going to talk about at our next session. So one of the things we've talked about so far has been really public markets. We've talked about the fact that you really make stocks, bonds, cash effectively. And there's another whole set of returns that are available that we would recommend that most of you have in there. And I'll tell you why in a minute. But generally, these are private investments, and they're private investments that need to be carefully underwritten. And because the returns, what you're looking for by adding private investments, which are called alternatives, you're looking to add basically additional sources of return and hopefully with lower risk. And when you add those into portfolios, you tend to get portfolios that have a higher return and lower volatility. And to do that, a lot of people will say, well, I've got one of those. I've got, some guy pitched me this deal here, pitched me that deal there. What we've found a lot of our clients have when they come to see us is if they have alternatives, and most individual investors don't, and I think you're going to find you're going to need them going forward. But what happens is they have a collection of stuff that's not really put together. It doesn't all fit together. And it isn't also looking at it from a dynamic standpoint, like what is opportune today. And so I think the number one thing is to look at it from a portfolio standpoint. These are the asset classes that you might look at: real estate, private equity, structured and private credit, et cetera. And here's probably one of the most important things here. In public markets, the managers don't matter. The difference between the very best and the very worst manager in an area aren't that great, okay? If you go to the private markets, the difference between the best and the worst managers is huge. And so you want to get to the very best managers. And to kind of give you an idea, we could have a difference of 35% of your returns. And so that, you know, it's those are the kind of things that you want to get to the very best of the very best. There's a couple of impediments to that, and we'll talk about that you know, especially at our next meeting. But part of that is let me come back here. You know, part of that is really the fact that when you do this, if you get to the best of the best managers, one of the difficulties is most of them have huge minimums. And when I mean, and most of them are out of the reach to put a portfolio together. So and so what, you know, one of the things we've done with our clients is we've created a fund to be able to get to a lot of those managers, because some of them have minimums of $5 million, $10 million per, and that's just one position. And so you know, you need to figure out what's the best way to attract this, and we'll talk about that at our next session, which is, you know, which is right here, February 5th, you know, number 301. Let's just talk about the process and real quickly. Patrick mentioned this, and this is important. When you talk about going through an investment process, here's all laid out. Here is from start the concept of developing the policies that are needed to get to the right place, to developing the management strategies, to finally evaluating your returns. And this is the process that that you should go through on a continuous basis. This is what investment management should be looking.
There should be something like this.
Yes.
I think it's so important to identify those objectives, evaluate implement some type of strategy, and then some type of review.
And I think, and you capture a lot of this in something called an investment policy statement. Every institution, if you're managing, if they're asking us to manage money, will develop a policy statement together. Okay. And what that is, and what that says is that kind of lays out all of this. Here's the strategies we're going to follow, or here's how we're going to evaluate, here's what we're looking for, et cetera. And this is the detail that you need, and we believe you need in order for in order to get the kind of returns that you need so you can become financially independent. So financial independence is really all about really digging back those returns. Are you losing me here? Okay. So let's talk real quick. I'm going to give you a quick overview of the financial markets, and then we're going to wrap it up for questions. So one of the things as you look forward is there's a group that this isn't our research, but we do a lot of the similar type of research, is a group out of Boston called GMO, and they do a 7-year forecast of the returns of every basic global asset class in the world. And this is their 7-year forecast as of the end of September. And if you look on the left-hand side, and what this is showing, this is assuming that all assets kind of revert to their long-term mean return or their long-term average, which you'll hear advisors talk about. And this is what the future returns look like. They're over 7 years net of inflation. I want to point out the ones that are most common. The ones that are most common are U.S. large cap stocks, which they are projecting will have a negative 5.7% return, mainly because of some factors like valuation, which I'll let Patrick talk about in a minute. Yeah, there's bonds, which has a couple percent return. The point of the matter is that if the asset out, that doesn't mean that these returns will be bad for that entire period of time. There will be times when they're very good, but they're saying that the overall result is going to kind of look like this. And with that, you've got to look at it. You've got to evaluate. Well, how do I want my asset allocation to work? Do I want to be dynamic, or do I not want to be dynamic? Because if you look at there, and if I'm trying to make a return of 4% above inflation or so, 5% above inflation, there's not one asset class that I can buy and hold and just leave and make that happen if those projections are right. So I'm going to let you quickly, because we're running out of time.
Yeah.
Sorry to force you through this.
No. So let's touch on those that top-down view. So, we still remain defensively positioned. So if you think about we think that there are a lot of challenges moving forward within markets. So when we break this down from a policy perspective, you think about this from an interest rate perspective. Interest rates remain high; they remain in a restrictive territory. From a fiscal policy perspective, fiscal policy or government spending has been high. You've seen a lot of government spending, and that's been stimulus. Moving into a new presidency, you may see change to the policy. From an economy standpoint, we do see things starting to improve. You're seeing maybe go from a negative to more of a constructive view. You're starting to see commodity prices come down, which I think is very helpful, especially lower oil, lower gasoline prices. And then you're also seeing banks more willing to lend. We think both of these things I think these are nice things to see within the economy. Finally, from a valuation and markets perspective, we are a little worried. I'd say that, if you think about this from a valuation perspective, you've seen prices go from high to even higher. And what that's saying is that you're saying that prices are moving higher because there's a lot more expectations coming into this, that expectations need to move higher because earnings or profitability of these companies continue to remain high. Then from an earnings perspective, we are worried as well. We think that what you've seen companies do over the past 5 to 6 years is companies have compressed costs and pushed costs down, which has boosted profitability. And so we think that both of these things make it a little bit more difficult, especially from a markets perspective. On a monetary policy standpoint, we talked about how interest rates are still well above inflation, how they're restrictive. So what's this mean? This is just saying that, from a business standpoint, we still think interest rates are too high, where small and medium-sized businesses are still getting negatively impacted by higher interest rates that are causing more payments to interest. And we think that those interest rates are still restrictive and leads us to a more cautionary stance and more defensive positioning. This is some interesting work that we did. We broke returns down into two big groups. We broke them down into that valuation or that market optimism piece, and then we broke that also down to that profitability standpoint. And what you've seen so far this year is that you've seen market returns getting driven by that market optimism or that valuation standpoint, which is shown in the light blue. And this is concerning. What you want to see is that you want to see that businesses are becoming more profitable. And that has really been that is the driver of returns within markets. And so far, that's not what we're seeing. We're seeing expectations get built high and even higher. So then the next question is, well, how much market optimism is there? And what I would say is that market optimism is high. Now, this is a chart that we had since the end of September, end of the third quarter. Where this number is today is closer to about 28 times. So what's important to know is that you're 75% above long-term averages of 16.6 times. The team ran how much market optimism has been in market since 1980, and we found it's around that 16.6. And the numbers aren't as important as how far away you are from those numbers and the divergence of those two numbers.
And so what happens when those numbers are that high? Because
yeah,
what happens next?
What's tough about this is when there's this much market optimism, what you're susceptible to are negative returns and low returns. And I think this makes sense. I really do, because this comes back to the oldest adage in the book is buy low, sell high. And what you're doing today is almost buying high and you're praying for a little bit higher. So when you're looking out just 1 and 2 years, we're concerned. And when you look out even further, when you look out over 10 years, you get an even more negative viewpoint. And again, I think this makes sense because you're buying these assets at such a high price and there's so much market optimism getting baked in that what it's saying is that there's so much expectation. And when there's so much expectation, that leaves room for a lot of disappointment. Right. And that's why you see those lower returns.
Just kind of a way to wrap that up. Warren Buffett, who we all know his name, he had a saying that says this, be very, very fearful when people are greedy and be very greedy when people are fearful.
Absolutely.
And we seem to be in a greedy position right now. I think we're going to wrap that up right now. We'll go ahead and take questions and go from there. Do you want to take a shot?
Yeah, absolutely. So
yeah.
We got a question about crypto assets. It's become, you've seen Bitcoin move up. I think it's over 40%, Matt, since the election.
Yeah.
That has been something that we're starting to hear a little bit more and more about. This was also the case just a couple of years ago when Bitcoin was making its run, and then all of a sudden you didn't hear about it. So what I would say is that, maybe one day this could be an asset and an asset class. I think that maybe one day, maybe a couple of years, 10 years down the road, I may look back and say, yeah, this maybe has turned into an asset. Today, I think that's more of a speculative asset. Today, I think there's a lot of individuals that are in this asset class to make a quick dollar. And really, that's not what we're looking for when we think about it. When I think about it from a capital allocation standpoint, that is not how we're achieving the goals of our clients and what we're trying to do. Again, we're trying to get those consistent returns. So for the time being, I think that there's a lot of speculation in that area of the market. And, from an allocator's perspective, it's not something that we're really that interested in today.
Yeah, people, it's hot. And the part of that is that they may see the Trump administration may be a little more sympathetic to how those are regulated. So anyway, questions? Yeah, I think there's positive and negatives to it. In the positive, there's lower regulation that we see coming. There's going to be a cutting of government, and in one sense, that's very positive. In another sense, that's actually non-stimulative. When the government does deficit spending, it creates it creates stimulus in the economy, just like lower interest rates create stimulus in the economy. And if we, take $2 trillion out of the budget, which is one of the examples, we're pulling $2 trillion out. And one of the things you've got there is that when we get $2 trillion that comes out of the economy, it's not like that's necessarily going back into our pockets because we're overspending by that amount of money. So we're just kind of getting back to more of a less stimulative environment. And tariffs will have an issue potentially with inflation, et cetera. So I guess the best thing I would say is I think we're generally more positive, but it's going to be wait and see. We're going to just have to look at every policy and see how they all impact with each other.
And I do think that this also adds this layer of more volatility that you're going to see within markets. Yeah. As these dynamics start to change, you're going to see assets move around in price as they respond to different things that they may hear from a policy perspective. Mm-hmm. So I think when I envision this as a very big opportunity. Actually, I think it's going to be a great opportunity to make some really solid returns in assets that where you're not just hoping for higher, but you're buying at a really, really solid price.
And I'll give you this just last point. There's always going to be opportunities even when you don't necessarily expect it. So if we go back to the Biden administration and we go back to what its policies were with regard to energy. Energy was one that they were going to kill. They're just basically going to try to really reduce the fossil fuels. And when they did that, those fossil fuels, oil and especially, went through the roof. And those profits for those companies went through the roof. And so, as an example, if you go back and look at periods when everything else was having difficulty, those oil stocks were going through the roof, and they were being attacked effectively at the same time by in the market. So you've always got to look for the opportunity and look at it from every angle. This is really where we are. So, got a question or? Well, it really is going to depend a lot on the client objectives.
Yes.
But one of the things we can do is oftentimes say, all right, how do we marry those in? How do we reposition things in such a way to create as minimal tax issues as we possibly can, which is what you're speaking about with the capital gains issue, and looking at that from the standpoint of, okay, how can we reposition that without creating a lot of liability? There's a couple, and that's one way it can be done. The other is to say, well, how much is this capital gain in relation to my whole portfolio? Because if they're particularly vulnerable and they could go down 30 or 40%, the other thing is, I might, for a cost of 1 or 2% of the value of my portfolio, get rid of them. So you just it's all just understanding exactly what you're looking for, what you're trying to do, and that really that's a client by client thing.
And what I would add to that, I think it comes down, if there's one thing I would hammer home about, what we think about from an investment policy, it has to be a process. So it always comes back to that plan. Does it make sense? Can we, how is that position sized within the portfolio? All these things have to come back to the plan. There has to be something driving decisions, and it has to be that plan that drives the decisions that helps guide that from an investment standpoint. So, thank you very much